G'day and welcome to this week's video. My name's Robert Gowdy from Consortium Private Wealth, and this week we're just going to have a quick look at some of the research platforms that we use to get our share ideas and how we research, and particularly how we explain to clients some of the key concepts that we're trying to educate them to make their own informed decisions and have an understanding why we own certain businesses and we stay away from others. So there's no silver bullet for this. It's just a lot of reading and a lot of research that's spent behind the scenes after hours, and that's part of the job that I actually absolutely love. And understanding businesses and their potential is good fun. But also, on the other hand, understanding businesses and sectors you don't want to be in is just as important, because it can really, if you're trying to research the whole world, it's far too big. You'll never get around to all the businesses. So you need to understand the businesses and why that's the sectors that are important. And if you want to go onto our website, there's understanding the right asset class to invest in. There's a video series there that helps explains the right asset class to be in. So they can really narrow down your focus to a particular area to research, and it cuts out a lot of noise that you don't, and that saves a lot of time. So in the past, we still subscribe to quite a lot of different providers. Value Line in the US helps us with our global direct equity, so Google and Microsoft and the like, and we use Simply Wall Street, and that's the one that I'm going to show you today because it's a very good one for teaching clients about the key concepts. It's graphically very nice, and there's other ones we use like Stock Doctor, which give very specific recommendations on businesses that they love, but it's probably not quite as pretty, and from a customer point of view, to help explain some key concepts, having those good graphs are really important. So let's go and have a look at the screen, and what we'll do, we're here within, we're going to have a look at Microsoft. What I rate as one of the best businesses in the world. So it's going to give us a bit of an executive summary on what Microsoft do. I think we know basically everything they do. The market cap is $1.8 trillion. And it gives some indications of valuations, the health of the business, past performance, future performance, and gives obviously some metrics based on the previous financials and the balance sheet. So if we have a look at the share price, it can give us plenty of data and when certain announcements come in as well, and a bit of an eye on valuation here based on last year's information. It's saying that it's undervalued by 7.7%. Now, looking at the future growth, and this is where we spend a fair bit of time. Of course, what we want and what I've always spoken about is we want businesses that can grow their revenues. So we can see at the top line here, there is 36 analysts across the world that are analysing Microsoft. It's one of the biggest businesses about, so there's lots of companies and people that are analysing its fortunes and future growth estimates. So estimated to grow over the next 1 to 3 years by 10%. What's it done in the past? Well, since the past 5 years, it's grown by 27%. You can see here you've got total revenue, which is the total revenue of the business, and the earnings is the profit. So that's been going up quite nicely. Another important one to consider is financial health. How financial is this business? Does it have a lot of cash in the bank, or is it laden with debt? So debt to equity ratios, clearly here in the short-term stuff, we can see here that they've got nearly 174 billion in cash and 67.5 billion in short-term liabilities. Take one off the other, it means they've got in excess of $100 billion in cash. The chances of this business going broke is highly unlikely. That is a very strong balance sheet. Of course, that can be broken down into a debt to equity ratio, which is very important. Then we can move on to dividends. And I think what's really important to see here that there is a dividend. That's great. For me, dividends are not that important. I don't believe that paying a high dividend constitutes that the business is of really high quality. the dividend yield and the quality of the business have got no correlation whatsoever. So here they're paying 0.9%, a bit below the industry. But what you can see here, stability and growth of payments, that this is the dividend line here, and it's been going up all the way through. Fantastic. The dividend yield has gone down, so this is where I'm saying dividend yield really doesn't mean much. These guys keep paying the dividend that's gone up over time, and as the share price has gone up, that's where the dividend yield goes down. So there's a simple calculation there. What's more important for me is, what have they been paying out? Of every dollar that they get, what do they pay out as a dividend? And you can see here that out of every dollar they get, 32% is paid out as a dividend, and the rest, which is 68%, is retained within the business to build the business. So the likes of Google, Berkshire Hathaway, Warren Buffett's business, and Facebook, they do not pay any dividends at all. So I'm often very pleased to see when a business is retaining a lot of earnings, and that means that more than likely they're going to grow the business over time. Also like to look at the ownership, and what I'll do here, this one, given that it's a huge business, you can see here that individual insiders have only 1.4%, but that's 1.4% of a very large amount of money. So as a general business this size, you're going to see there's the fund managers, BlackRock and Vanguard, State Street, so you're going to see all the big fund managers there. There's Bill Gates with a very healthy 100 and huge 24 billion worth of shares. So you're not going to see the founders, apart from this case where Bill Gates is sitting, but you like to see that the management own some of the shares themselves. So you can see here that the CEO is he owns $416 million worth, so it's 0.023% of the business. But these are the things that we very much like to see, that the people running the business are aligned with us as shareholders. So we can see here that there's some pretty big numbers there: nearly 150 million, 81 million, nearly 214. So of course they're going to do the right things by themselves and their family, but of course they're shareholders as well. So with Simply Wall Street, we pay for a pro subscription. I'm quite sure there is lesser subscriptions that you can subscribe to, and so log on, have a look, get a free membership. Of course you'll get some marketing. Now there's no conflict here at all. I do not know the people who run Simply Wall Street, other than it's helpful for me to help educate my clients, which that's what matters, is the clients and the advice we give. Thank you very much for listening. I hope that was valuable, a bit of an insight to what I do and what I look for, and we'll catch you next week. Thank you.